thank you all for assuming some liquidity risk and showing up this evening. I'm hedging. Well, I'm going to just take a couple of minutes and frame the discussion. We have a group of individuals, a collection of individuals that know a great deal about this. I'm not going to bother to read the bios. The bios speak for themselves. What we will do is we're going to divide the evening into two sessions. We're going to lead with Steve Allen. Is that right, Steve? And you're going to discuss market risk as contingent liquidity risk. Steve's discussant is going to be John Bright, Merrill Lynch. And John, you'll have some interesting comments about these station insurance. Then we're going to take questions and answers from the audience, followed by Roy Henriksen, and then Tobias Adrian from Fed will provide us with some insights with regard to Roy's presentation, which is very important. How do we distinguish between liquidity risk and systemic risk? When does liquidity risk become systemic, a systemic problem, or vice versa? Is there a relationship? We started the liquidity risk committee because liquidity risk is probably one of the most ubiquitous risks existing in the financial markets today. But it's probably one of the least understood risks. And we're going to challenge the group to participate with the liquidity risk committee on an ongoing basis in terms of rigorous dialogue, rigorous discussion, rigorous thought, and inquiry into the nature of liquidity risk, how liquidity risk relates to other risks in the marketplace, and how does it then manifest itself as systemic risk or contribute to systemic risk issues. Liquidity risk is an interesting thing. It's been modeled as options, types of options. It seems to have some relationship to what we call market externalities, and probably one of the oldest papers on a type of liquidity risk that was related to information asymmetry is the original market relentless problem of I guess the 70s, right, Roy?
Yeah.
It was back in the 70s, and there's some interesting things one can do by taking that model and playing with it. One can also think about financial markets as a search and matching type of a game. And if you can imagine a search and matching game where people are holding some very heterogeneous types of things. So I like to use the example of everybody out here is a clothing merchant, and the market is platform shoes and leisure suits. Bright banana yellow leisure suits and lime green leisure suits, and then platform shoes in either vinyl or anaconda. And the leisure suits are either silk or polyester. And we're running around and we're buying bundles of this stuff. And when you get your delivery as a merchant, you may find you've got a bunch of lefts and no rights. You do know that you've got some silk stuff, and you know you've got some leather stuff or some anaconda, some vinyl, but you're not really sure. You find that your lefts don't match with your rights, and your tops don't match with your bottoms, and your colors are mismatched. And so you run around trying to find people that have complementary lefts with the rights, and so on and so forth. And at some point in the future, you're going to find out whether it's a world that loves polyester and vinyl, or a world that loves silk and anaconda. Okay? And if you found the right people to match up with, okay, and it turns out to not be the world that likes the particular material you have, you can survive to the next set. All right? If it is the world that likes the material, you can sell your stuff at a profit. If you find the wrong partner, okay, and the world that you expected does not obtain, you have to liquidate. And if you're a high-cost guy who bought all the silk and anaconda, and you have to liquidate, you have to liquidate a lot of money. If you're the low-cost guy, depending on how much you bought, you may have to liquidate for a little bit of money or a lot of money. That's the kind of crazy search and matching stuff that can lead to liquidity risk and maybe systemic risk. So with that sort of a mental exercise, that sort of mind experiment, I'd like to invite Steve Allen to talk about the relationship between market risk and liquidity risk. Thank you.
Someone's going to have to show me how to get to my talk. expert in the room?
Turn the volume on.
So thank you very much, David. Thank you very much for having organized all this. Thank you, John, for allowing me to rope you into being the discussant. And thanks everybody for coming. So I think as a starting point, I'm thinking about the relationship between market risk and liquidity risk. Well, we all know that liquidity risk is certainly an important part of market risk. But what I wanted to talk about was that thinking about it, I came up with a paradigm, a way of thinking about it, a view in which liquidity risk really plays a much more important role, a very major role in market risk, more so than what we normally think about it. Well, we have to, how good is this paradigm? Well, I'll leave people to judge. I try to run with it. It leads me to, in thinking about it, led me to thinking about some problems that I can't quite see the solution to. And one of the reasons I want to give this talk is to throw those kinds of problems out as challenges. I hope that some people in the audience will find this interesting enough to think about it themselves, and I hope if you come up with some interesting approaches to those challenges that you'll share them with me. All right, so start out with it. I'm thinking of the fact that we all know that a key to market risk management is an effective use of stop loss limits. What I think is that you can sort of take a principal component approach and break market risk management down into two pieces, into stop loss limits and into managing the liquidation risk of positions when they need to be closed out because of stop loss limits. So it's a contingent kind of liquidity risk. To see how this works more clearly, I want to start with a thought experiment. I want to try and create a thought experiment in which we wouldn't have liquidity risk. So suppose you could have a firm of traders, and instead of having them be employees of the firm, you can have them be independent contractors. And suppose they only trade on public exchanges, not futures exchanges. And the firm announces in advance it's going to supply capital to the traders, but it's not going to back up their positions. If they go broke, they have no call on the firm. Now, it's still, I think, under these conditions, I haven't really investigated all the institutional implications, but I think it would still be plausible that people could trade under these conditions. Because after all, the main thing that brokers on futures exchanges are looking for is you put up margin. If you can't meet your margin calls, they can close you out. And so it seems like the exchanges the brokers for the exchanges would have a way of managing this risk. In conditions like that, the thing that's interesting is for the firm who's employing these traders as independent contractors, they can estimate their risk very, very simply. Their market risk consists of the amount of capital they've committed to the traders, and their potential risk is the amount of capital that they've committed to the traders and that the traders have not been utilized in futures positions. So in this case, all trading management decisions would be around how much capital should be allocated to each traders, and whether you should add capital when a trader runs through his capital. And you would see whether the risk management system was a well-disciplined system by basically looking at the discipline around how those stop loss limits are managed. Does the management have a good dialogue with the trader when he runs through his capital? Do they say, well, why should you continue? Why should we put up more capital? Why do you believe that this position will make back, will come back and start making money again? Or do they just say, oh, well, all right, you ran through your capital, here's some more? I mean, so you can see very clearly where the discipline is around a stop loss system like that. You also have the ability, trading managers could withdraw used capital if there was a change in market conditions, if the markets got more volatile, or if there was a change in firm-wide strategy where the firm did not want to take as much risk. But they have to recognize that by withdrawing the unused capital, they could be sabotaging the trader strategies. The trader strategies might have depended on the ability to use the full amount of capital that the firm had originally set. In circumstances like this, would we need all of the usual market risk management paraphernalia? Would we need VAR? Would we need stress tests? To a certain extent, no. To a certain extent, you already know what your risk is. It's the capital. To a certain extent, well, maybe it still could be useful. You still would want to ask questions like, are the traders following diverse strategies? You wouldn't want to be employing traders who are all following the same strategy. So you still might want to add up their positions. You still might want to have your management see something about what the total positions are. But it's a very different type of approach. And what I'm saying, the reason I'm putting up this thought experiment is it's a very good prototype for thinking about a stop loss risk. Then you have to say, all right, so what happens when we go back to the real world, the world as we know, where firms provide credit guarantees for their traders' positions? Well, you still have to have the same kind of stop loss limit system still is a critical system. You still have to ask yourself your questions about, is the firm using a disciplined approach to stop loss risk, to stop loss limits? But now, because you have to absorb the losses that take place when liquidation occurs, it's not the futures brokers who have to worry about closing the traders out when they run out of capital. You have to worry about closing the traders out when they go through their stop loss. So you have to be able to estimate and control that liquidation risk, and that's where I say that's the contingent liquidation risk that you have to worry about as a key part of the market risk. I'm going to divert for just a second here, a little aside, because I was thinking as I'm doing this. Well, does this, this paradigm is sort of obvious. The paradigm is sort of obvious how it applies to proprietary positions. Does it apply to also to market-making functions? And I would say yes to a certain extent, no to a certain extent. Yes, it does, because market-making desks do take proprietary positions. Market-making desks do put on positions where they're accommodating very long-term, illiquid customer needs. In those cases, the key to understanding their risks is understanding their current positions. But market-making desks also take on a lot of liquid positions on behalf of the customers that they have to do in order to be market makers. Their current positions aren't particularly relevant. And there I'd say this is not a good paradigm. You need a different paradigm for estimating their risk, which is to make some kind of forecast or some kind of modeling of what happens if you continuously get stuck with liquid positions that you don't really want to have that you're taking just because of customers. All right, so now we come to the critical point in all this. So how do you calculate this contingent liquidation? And one thing that I think is obvious is it has to be very different from liquid and non-liquid positions. For liquid positions, that is positions in of a size and type of trade where you normally got liquidity. Here's where we use our very traditional risk management. You have your value at risk that gives you a statistical calculation of how much you could get as an extreme movement in a normal day. In other words, you're telling a traders reach the stop loss, you want them to close out this position, but it's in a very liquid position, very liquid market. it takes time. You have to have a conversation with it. You have to have management realize that the stop loss has been reached. You have to have management have a discussion with the trader and make a decision, do I want to let him continue with his position or not? So there's going to be a certain delay. You want to know what the contingent exposure you've got from that delay is, and FAR is a very good way of doing this. It's good statistical measurement. On the other hand, even the most liquid markets can go through periods of illiquidity. We've all seen that. That's why stress tests are a necessity, because it could be that, in fact, very often when people go through their stop losses, it's exactly in those periods where the market's moving so fast that a normally liquid market is turned to liquid. You're telling the trader you want to put the position down. FAR is not going to tell you very much about how much it's going to cost you. In those circumstances, an experienced judgment of the stress, the great stress test is much more meaningful in those circumstances. And finally, and always most important of all, you've got to make sure your current position is mark to market, at least daily. The last thing you want to be doing with the stop loss system is have the trader know that he's through the stop loss and you don't, because that's the kind of circumstances in which traders would take risks that the firm would very much not like to take. What implications does all this have? Does this have? Liquid positions for model validation. Having spent a lot of my career in working on those two topics, that's a natural thing for me to be thinking about. Models are pretty robust in these kinds of situations. You're basically using them perhaps for interpolating between liquid market quotes, perhaps definitely for calculating the impact of market changes on positions in the VAR and stress tests. But it's very easy to test these models because they're constantly being checked against liquid market quotes. You can constantly see, did this model tell me what really would it cost me for a one-day change, for a 5-day change into the positions. Also, you've got the advantage, you only need to be concerned with your current units. You don't have to worry, well, suppose the Vega will grow to such and such if we have more volatility or at a different price level. If you get a brief that you don't like, you can always tell them it's a liquid position. You can always tell the trader to start shutting it down. So you only have to worry, are you happy with the current briefs? Things change a lot when we start looking at liquid positions. And here I think we have to distinguish between 3 different types of liquidity. You have some products that have sporadic liquidity. You get quotes for them, but they're not up to the minute. They may not be even every day. They're kinds of things where you see quotes, but they're less frequent. You can have a product that has full liquidity, that is, you see quotes all the time, but your position size may be so large that you can't really liquidate it. And finally, you have products where there's a one-way market. For those of us who work for investment banks, we've certainly seen a lot of those. You have products where all the investment banks are in one direction because they're accommodating customer need. If you want to close a position like that out, good luck. Call up your friendly competitor across the street and ask him to close the position out for you. He's reserving all of his firepower for accommodating his customers. So, for a product with sporadic liquidity, that I think is a pretty straightforward way to handle it. You have to have a model that relates pricing of that illiquid product to some related product with full liquidity. If you've got a bond that you find difficult to get quotations for, well, relate it to a much more commonly quoted bond. You have to change your market continuously because you, again, never want to have the situation where the trader knows he's doing stop loss and you don't. So you continuously should be changing your market at least daily based on how the liquid related bond is trading. But you have to recognize that there's an added liquidation risk caused by the uncertainty of the relationship between the two. That you re-estimate every time you get a quote for the lesson. But the key rules are, first of all, you can't have an illiquid product that you don't show a larger risk on, a larger liquidation risk on than a related real option. There's never an excuse that, oh, well, when I see the quotations, they don't move that much. It always has to be at least as much liquidation risk and somewhat more than a related. And the second is you have to keep checking your models, but that shouldn't be so hard because every time one of those sporadic quotes comes in, you can see how well your model picked up the relationship between the more liquid proxy instrument and the less liquid actual instrument. Where you have a liquid product but an illiquid size, there are a couple of possible ways of doing it. One way is you can use a VAR-like kind of price move, but do it over a longer time period. If it's going to take 30 days to get out of a position, if it's a position that's large enough that from the time that you tell the trader you're through your stop loss, we don't want you to get out. If it's going to take 30 days for you to liquidate it without moving the market, then look at a VAR over 30 days. Another way, for those, if you have a model of market impact of large volume, that's another possibility. In all cases, both cases, you have to remember that's liquidation beyond the normal liquidation costs of a small size, which should continue to be estimated for our stress testing. And here, you can't be satisfied with just your current risk. Because if the market, if a large price move could bring about a vega that you're not comfortable with, it's too late at the time that you see it to tell the trader to close it out because it's going to take a long time to close it out. So you have to, for large positions, be concerned not just with current rates, but with potential rates. The hardest one to work on is where you have the one-way market. Now the model becomes very critical because you have very little price information you can go on. The model's hard to validate for the same reason. You want to employ as much liquid market data as you can so that your markets don't become stale. But you also have to make sure that you identify which of your inputs are illiquid and that you estimate the liquidation risk of those illiquid pieces relative to the net exposure that you got to the illiquid inputs. Model Greeks are not particularly useful. They tell you the impact of small moves. Small moves are not what you're worried about one-way market conditions. And this is, you can tell where I come from having worked for years for a central firm risk management group, and I say it's very important that you make these assumptions. If you don't want to be, there are too many hazard risks where the traders have influence on this measure. So there's a paradigm that I'm pushing here too. It's a paradigm of finding a liquid product that proxies your one-way market product. Use that liquid product to represent the trades in all of the standard computations like VAR and stress testing. Model the differences between the actual product and the liquid product, and use that to create conservative liquidation assumptions. An important point here is this liquid proxy, and one that often is controversial with traders. The liquid proxy is not supposed to be a way of telling the trading desk this is a hedging action you have to take. It's supposed to be a form of representation. Though, of course, there's always the possibility that you might decide you want to start closing the position down, and then it moves from a form of representation to a form of mandated hedging action. Now, how do you model the differences? One way is to try and have a big simulation model. I've seen very few instances where that really has been built, and if it was, it would be built basically by the trading desk. It would be very difficult to monitor how accurate it is. So I've focused on trying to find ways that you can work with less frequent hedging ideas and something that is more possible for the central risk management to build themselves and monitor. So this is my, the paradigm that I know has definitely worked many times that I've seen is, suppose you've got something that's one way, that's a long-term instrument. You've got a liquid two-way market. It swaps after 7 years, a one-way market for 10 years. How do you model it? Well, when the firm puts on the new 10-year swap, put a 7-year swap as a proxy into your firm's VAR and stress testing systems, and then estimate the cost, the potential liquidation cost of the 7-year versus the 10-year by saying, well, look, in 3 years, this 10-year is going to become liquid. In 3 years, it's going to become a liquid 7-year. At that point, you could swap 7-year for 4. You could swap you could swap the 7-year proxy, which at that point was 4 years, to a 7-year proxy, but then it's no longer a proxy, it's real. In 3 years, that's really what you have is a 7-year position. So your liquidation cost, in this way of looking at things, your additional liquidation cost is the cost of swapping that 4-year proxy to a 7-year proxy. And that's something you can get a lot of data on. Every single day that you have liquid quotes for the 4-year and 7-year market, you can use to estimate what that potential cost is. And I just note that this is something that can also be used for illiquid maturity options for Ks, though it's a little more complex because now you also have to worry about the whole volatility swings. Another example, sale of a digital auction. I think it's been long been known as a proxy for a digital auction, that we model it as a call spread. How wide a call spread? I mean, the narrower the call spread, the closer the fit to the digital auction, but the more liquid you make because you need a large size. You want to get a size that's small enough that it actually you actually could treat it as a liquid instrument. At that point, you've got real differences around the point of that the digital pays off between the digital option and a proxy, and those are the differences that you treat as your potential liquidation costs. Barrier option, this is a technique I think that's known to many trading desks that Peter Carr and people that he's worked with have pioneered to say, well, look, if you've got a knockout call option, knocked out as a barrier, you can model it by saying buy a standard call and sell a put that's below the barrier. If the barrier never gets hit, well, the put can't have any value. If the barrier does get hit, then at exactly the point that you hit the barrier, you sell off the remaining call and put option. Peter has established certain conditions under which these are an exact match, but it doesn't cover all conditions. It doesn't cover conditions where there's volatility skew, where there's drift in the forward. The proposal here is do it to an optimization. Define scenarios in which you're going to different scenarios in different volatility levels, different times that the barrier can be hit, and find a portfolio of options that give you as small a differential in those scenarios as you can. If you just completely take the same assumptions as Peter's assumptions, no skew, no drift, you get exactly the same solution. But it gives you the ability to model a broader set of conditions, and where you've got uncertainty as to what skew and drift are going to be, it gives you a way of calculating what your potential liquidation costs are. And that, I know, it can be used to easily extend to a lot of other types of special payout, exotic payouts, double barriers, partial barriers, look-back options, and compound options. So now I get to the challenge part. Pique somebody's interest here into areas that I think are harder to handle under this paradigm. it mostly are areas that have to do with some way of correlation risk. So one is, how can you do proxy with a liquid American option? Particularly, an interesting case in the U.S. is American liquid swaps. How can we use liquid European options, or if they exist, liquid American options as a proxy? The most reasonable proxy is a series of European options at different tenors, but then you have the problem that, well, if your American option doesn't get exercised until, until you're, say, halfway through the period, you've already had some of the European options that you were using for liquid proxy mature. What are you going to assume about the price at which they mature, the payoff that mature? You've got to now be looking at scenarios, not just as in the three cases I talked about before, where you can define the scenario at one particular point at which you make a trade. But now you've got to worry about a whole set of paths, and how can you keep the number of scenarios down to a reasonable manageable number? Second challenge: how can you take illiquid CDO tranches and use liquid single-name credit swaps and liquid CDO tranches to proxy them? If you're going to avoid dependence on CDO tranche pricing models, which I think you should, I don't think we've shown that we have any experience for testing them and having confidence in them, then you have to do this in a way that relies on the final default loss outcomes. Any static hedge you rely on, when you look at it under final default loss outcomes, is going to show large variances between the position and the proxy. Even if you assume that expected loss was known, even if you assume that correlation was known, just the nature of the fact that a correlation structure automatically assumes that there's some variance that they're going to have. And anytime you have less than greater than zero correlation, you're assuming that there's going to be volatility between losses in some periods and losses in other periods. So there's going to have to be some substantial differences between the final payouts on your illiquid tranche and the final payouts on your CDSs and liquid tranches. So that sort of points in the direction of using dynamic hedging to try and hold that liquidation risk measured down. But if you're going to use dynamic hedges, what are the rules? And finally, using liquid single name and index options and forwards as proxies for illiquid options and equity baskets. Any static hedge is going to result in large variances in the position of the proxy in a very significant percentage of scenarios. Fortunately, here, dynamic hedging with forwards is very easy to do for a simple basket option, because you can just use Black-Scholes formulas for the differences between your illiquid option and your liquid options. But I don't know how that would work with complex rainbow structures. That's I think would be a real challenge. So. I hope that gives you a clear picture of my paradigm, a clear picture of where I see the challenges are, and I would definitely very much like to hearing anyone who has some thoughts on this. Thanks.
Thank you for being patient with your questions. We will now have our esteemed discussant there to offer some of his insights into the challenge. Are you going to sit there? You're going to come up?
Yeah, I was just going to stay right here. Oh, this thing does work.
And I get a better view of it this way, so I'm going to stay here.
Oh, okay. Yeah, Steve asked me to do this, and I, of course, said yes, because we've been friends for years. But I must confess, I've never been to one of these events, and it hit me yesterday. I had no idea what it was discussing. does. Yeah, fortunately, Bloomberg has the LED, so I looked it up. It seemed like an archaic word you'd be able to find there, and sure enough, it was. And it says my job is to belabor some of the controversial things that Steve has said. So I'll take a stab at doing that, and then I guess we just open things up to questions. One thing that occurs to me when thinking of market risk and liquidity risk, and one being a paradigm for the other, and my mind goes back to '98 when I was at DLJ, and we had the business that probably everyone had of financing Russian bonds and GKOs for Russian banks. Now, we weren't so foolish as to not understand that this was probably non-recourse lending at some point. But the interesting thing that came out of that experience for me was, I think anyone looking at market risk, looking at VAR, looking at volatilities, any normal measure of market risk, would have said that MinFins, long duration Russian bonds, are riskier than GKOs, which are essentially were Russian T-bills. From the financing side, just the opposite tended to be true for us. And the reason it was turned on its head was, the Russian banks who were financing had a certain amount of money. They could meet a few margin calls, and then all hell broke loose. The MinFins, because they were long duration bonds, the market could take them out. Before the whole world started coming to an end, you would have Russian spreads widen, long duration bonds go down in value, you hit a margin call trigger, But at any rate, eventually they ran out of money while you're still in a normal, or not quite normal, but still in a state of the market where there's some liquidity and some things are trading. They're trading down hard, but they're not falling off a cliff. GKOs being essentially T-bills are going to stay at a reasonable level until it's apparent that the government is going to default, and then they drop like a stone. So I think, even if you look at where things were resolved, the MinFins lost more value than the GKOs, but the GKOs were the much more difficult one to finance. So one controversial thing that I'm trying to belabor here is sometimes the sort of liquidity risk you would face in a prime brokerage operation, at least in this case, and I think it happens in others as well, is almost the opposite of what we would have thought of as the market risk hierarchy. The bigger market risk securities, sometimes the easier one to finance just because normal events can trigger the market fall rather than a disaster. And the other thing I'd like to spend a little time on is the one-way markets. This is, Steve alluded to it, and all of us in investment banks see them. It is a huge part of the derivative business, is spinning flax into gold. And so you create some security, what's a good example of yield curve notes. So there seems to be an endless supply of investors in Asia who would like to bet that the U.S. yield curve will not invert, particularly 2s, 30s, and then swaps, not treasuries. And we'll place that bet, and we'll get a whopping big coupon as long as it doesn't invert, but if it does invert, their coupon's gone. And in the usual investment bank of heads we win, tails you lose, by the way, it's callable, so if you're actually winning, the note's going to come back. Now, so that, and this happens all the time, investors trying to sell some option on something that they don't think will happen and get an enhanced yield. This is, we pay then for this option far less than we think it's worth. And every investment bank is the same way around in that trade. So it's, if we ever wanted to get out, not only would they rather deal with their customers, but if they were willing to deal with us, any investment bank would give us the customer price rather than the price we've marked the thing up to. Now you can look at these trades and construct proxy models, and we look at where correlations are trading. You can sort of infer correlations from some American options. You can look at outright options on various parts of the yield curve. And so you can get some data on that. You've got to look at vol skew and how bad it is. But in the end, the actual behavior of these is going to be distorted if you ever want to liquidate. Because you're not, no matter how good your model is, there's always some set of parameters you can put into it, some stochastic vol model, something that will reproduce the customer price rather than the dealer price that we all think is the correct price. You will also have other dealers who, just for fun to torment people, will put trades up with brokers at levels well through where everyone's marking it, and you'll have people in finance wondering which one's right. The broker trades will be dwarfed by the size of the customer trades, but still there's always going to be that uncertainty of where to market. And this to me is a challenge of, the real challenge here I think is how do you recognize when there has been a genuine paradigm shift? This happened in cliquets, but when was the cliquet? That's 3-4 years ago? When the whole cliquet market essentially repriced. And how do you know that the models were wrong? One of these third or fourth order effects when you got really big were really important, and you were ignoring some component of stochastic vol or something else, so that you really are off the market and should stop out the position. And how much of it could be, no, this is genuine. You've just got a one-way market and you live with it. And you can get some signs from how the position carries, but for me, that's a very difficult one also to apply to the paradigm. So that's my belaboring, and I guess we now have questions.
Yes, we now have questions. We're going to, I'll be repeating the questions rather than running around with the microphone. First question.
So would you like to discuss like your one-way market? Let's say the recent event, one of the very recent example would be the ABX. You traded CBS on the ABX index itself. And
The ABX versus the components or something?
No, don't even worry about versus the component. Let's say just ABX.
ABX.
Yeah.
I was going to use that as my example, and I thought, given all the rumors, that it would, it wasn't appropriate. But look.
May I finish my question first?
Yeah. Oh, yeah.
I'm not trying to make a mistake. So could you discuss how to apply this paradigm to the example of the ABX, and how should you look at it as a risk manager from the buy side versus a risk manager from the sell side?
Well, I have to say, this is not, I guess it's a sign that I'm no longer an active risk manager, and I'm not really the active.
Let me just say one thing.
Sorry, can someone repeat the question?
Yeah, the question is basically, how should one be looking at the ABX index relative to the underlying contracts? And then is there a difference in view between the buy-side risk manager and the sell-side risk manager with regard to the ABX? Yeah. ABX, by the way, for those who are not familiar, is basically the credit default swap index that references asset-backed issues, as opposed to corporates.
Yeah. And in particular, it's referencing the typical BBB minus yield bonds that go into most ABS.
Which, by the way, are very heterogeneous around a lot of their covenants.
Yes.
And composition.
Yeah. And there are very thin slices. So you have an index based on very thin slices. Which, let's say you look at, all right, we start getting really bad news in subprime. Delinquencies are up. So what do? How do we turn that into losses? You have your usual curves for the delinquencies, will eventually turn to losses in certain percentages, some of them cure. But there's enormous uncertainty about what it will actually be. So you see the ABX go from par down to 72 or something, and you start thinking, geez, maybe it's a buy opportunity. On the other hand, you don't know if 72 is where did it stop? These are thin slices. If you have enough defaults, they're gone, and then the index goes redeem at zero. If you're on the other side of the trade, you're one of the hedge funds who was shorting it, how are you going to, you've seen it go from par to 72. Geez, you'd love to take your profit, but there's no one willing to trade with you either. And if you just hang on to it forever, you better hope that there's enough defaults that you get realized joy out of the thing rather than this temporary mark-to-market that it went down and maybe it goes right back up. So it's very hard for either side, the shorts and the longs, to know where this thing can settle because the tranches are so damn thin. They're very sensitive to the model assumptions. So to proxy something, which is that sensitive, I think would be a challenge.
I mean, when you say, without commenting much on the specific case, really, but as a general rule, I've tried to stay away from how you mark the market as an issue here. So I have my views. I tried to focus on, well, how do you estimate the risk? My personal view is that whether you're on the buy side or the sell side, you should be marking the market where you actually can close out a trade in a reasonably short period of time. And therefore, if you have the liquid positions that you can close out in a reasonably short period of time, I think you should be setting things up in such a way that you can have virtually only positive surprises, which means taking a substantial part of the risk estimation and reserving against them. But that's my own view of what accounting should be. How in terms of how you should estimate the risk on these things, I mean, yes, I think proxies can be difficult to establish, but I think I do think that the guideline ought to be try to establish proxies on the basis not of a model, but on the basis of actual payouts. And there, I think, it gives you a guideline. It forces you to think in terms of scenarios of what the actual payouts are going to be. And yes, determination of those scenarios and the probabilities around them are going to be somewhat subjective. But I think where you get some robustness is the fact that you don't have to be that right about it, because what you're trying to do is estimate your risk against a pretty broad band. Like you want to know what there's only like a 97% chance. So that means that even if you're somewhat, you can be quite wrong about your determination of the scenarios and still have a pretty good handle on what the risk is.
It does raise one interesting thing on the question. But what happened there frequently happens where you have something like an index, which is more liquid than the individual component parts. So you have the index and the components diverge, because the index is the only thing anyone could short, and they were out doing it massively. It raises an interesting question for all of us of which we believe. When the components which don't trade that much are sort of hanging in there, but the index, which you should be able to argue if you couldn't, because no one could trade all these pieces, is plummeting. Do we then assume that our components are going to plummet, or the index will come back to them? I don't know, but it's an interesting question.
Well, there's an interesting question there about episodic liquidity in two assets that are supposed to be related.
Yeah.
And in one environment, the index is more liquid than the underlyings. And then in an environment where the index becomes completely illiquid, and on a relative basis, the underlying may be somewhat more liquid. And so you run into this kind of bizarre behavior. I guess before we move to another question, there's one other thing that we take this away from the world of ABX specifically and say, we're back to the world of platform shoes and leadership. And you've got a player out there who's on the buy side, and he has a massive short position on the platform shoes leadership index. Okay? Now, the funny thing about it is he who controls the supply of actual platform shoes and leisure suits has kind of two kinds of things to control. One thing that they can do is they can loosen or constrain the actual inventory of platform shoes and leisure suits, the pipeline. And the second thing that they can do is that they can continue to lend money to the merchants and keep them from actually having to liquidate their positions And so the funny thing about certain assets like the ABX and their underlines is if guys can make it all the way to the end before they default, it makes it very difficult if you have a massive short position on that looks like it's massively profitable on paper to ever get that lifted and turn it into money. All right, and without discussing specifics, that's an interesting liquidity issue around exotic synthetic things related to other things that are supposed to be the underlying components. And that might help with your question as well.
Yeah. Well, actually, may I follow up? I know you don't want, you bypass the mark-to-market, but for the buy side, the mark-to-market, how should you mark-to-market for this type of liquid one-way market? And how could the buy side even find out how liquid market is?
Well, I mean, I don't want to give somebody else a chance, but just very briefly is, keep track of where you actually sell things. I mean, if you're selling things at where market quotes are, then that's fine. If you're selling things well off of where market quotes are, you've got to build some kind of model.
The other way to look at it is my example says something about liquidity being agent-specific versus asset-specific. Who's holding the cards? Who's the guy from out of town who doesn't usually sit at this table? Versus, who else is sitting at the table that plays cards with each other all the time, all right? And who's the one that's carrying the most money at the table that week, right? And is it roulette or is it poker? Got it. Do we have another question? That's it for questions? It was just either that good or that complicated. I see someone's got their hands over their mouths, but he's not yawning, so maybe he's got a question he's afraid to say. No? Okay. All right, so why don't we move on to the next group? We thank you very much, gentlemen. Technical support experts who be here to help us transfer this stuff over. Our next speaker is Roy Henriksen. Roy knows a lot about liquidity risk from first-hand experience. I will say that Roy was one of the people involved in helping with crisis management around portfolio insurance during the crash of '87. He got a panic call from a famous guy saying, what do we do when we're observing that the cash and futures have separated or diverged in a way that we never predicted before. And so Roy's got some insights. I'm sure he's going to relate them here, because you had a systemic as well as liquidity risk issue that day, right?
That is true.
Okay.
Thanks, David. Unlike the previous panel, I'm not going to try to come up with any answers here. I'm basically going to raise some interesting questions, try to put a little structure on the issue of systemic versus liquidity risk, and then do a little bit of storytelling. When you look at systemic risk, you think of systemic risk, again, as maybe just because it's where I learned this, or I really actually learned it, was I always think of October of 1987. October 19th, 1987, many of you were not in the markets at that point in time. If you were, it's kind of a milestone that you measure a lot of things by. On that day, remember, we had, back on February 27th, the S&P 500 was down a little over 3%. It was the first time since 2003 we had a down day of more than 2% in the S&P 500. Put that in perspective. On October 19th, 1987, the S&P was down over 20% in one day. Put that in a little more perspective. Except in 1987, there hasn't been a week where the S&P was down by as much as 10% since the 1930s. David told the story about the divergence on the S&P from basically between the cash market and the futures market. Over 10% divergence at the open. That's the difference between the price at 100 or the price at 90. That's a lot. That's sort of like in terms of the precision we're talking about here in terms of trying to deal with some of these liquidity issues in terms of hedging. Think of what that means in terms of the delta on somebody trying to do portfolio insurance. which is the security, what is the price? You don't even know the price. On that day, the tape on the New York Stock Exchange was lagged by over an hour. In other words, you didn't know the trades that were done and executed and at what price for well over an hour after the fact. That meant that most of the trades, or most of the trades that people were trying to do on that day, they had no idea whether or not they got executed. And if they did, they really didn't have any idea at what price. Think about that relative to the system you're dealing with on a day-to-day basis. You plug things into the computer, and you basically find out pretty soon, almost instantaneously, did you get executed and what the price was. Okay. Over the last 20 years, there have been 8 days where the S&P 500 was down by more than 5%. Of those days, 4 of them were related to October 1987. There have been only 35 days when the market was down, the S&P was down by more than 3% over that time period. 7 of those were related to October 87. So this was a market where, in some ways, if you're thinking about differences between market risk and systemic risk, this is kind of what I use as my benchmark. From that perspective, the way I like to look at systemic risk, and what I'm going to be talking about here is the way I look at it. Okay? It's not just, systemic risk is referring to the likelihood and the potential severity of events that result in shocks to the financial system. Okay? Those events, like 1987, are events that happen suddenly. They have a severe impact on the markets. They're widespread across a number of markets. And for the most part, they're events that are unanticipated. They're events that cause tail risk across a wide range of markets. More importantly, I think, is that when you're talking about systemic risk, you're really talking about issues that relate to the integrity of the financial system. You're talking about things that really matter from the point of view of the economic impact of the trading system on the way we do business. The questions that we rely on as sort of being given are the ones that you have to ask. You certainly were asking these back in 1987. You were asking them in 1998. You were asking them after September 11th. Are contracts of the trades going to be honored? That's something that you don't typically think about in the course of looking at the way you're dealing with the market. Will the market be able to function in a way that we've been accustomed to it functioning, as a way that we basically rely on it? Is it going to be able to provide the capital needs for worthy investors in the role that it's playing? I mean, the fact is the capital markets in this country and the institutions behind those markets play an incredibly important part in our economy. Not just the profits and losses that you're making on this, but they play a real role. They have a real impact on the economy. In that respect, market risk is different from the risks to the financial system. When you're looking at this, what you're focusing on, what I'm saying is systemic risk, for example, is related to, but it's not the same as the potential for large losses. You can have large losses just from underlying economic uncertainty or the role of leverage or defaults in an economy. Okay? That's different from systemic risk. Amarin basically went out of business, got wiped out. I wouldn't do that as a systemic event. It was certainly an event that was catastrophic for investors in the fund, but it didn't have any large impact on the overall system. Okay. Shocks are something different. Okay. It's almost like the difference between micro versus macro, or bottom-up versus top-down analysis. From the jargon of the stochastic calculus, it's the difference between jumps and diffusion processes. It's talking about the non-stationarity of the traditional portfolio parameters that we look at when we measure those distributions. Okay? It's basically things as simple as thinking back to 1987, focusing on what is a realistic PE versus what is the right earnings for a particular stock. Okay? It's that kind of difference that you're looking at. Now, as an empiricist, or a former empiricist, one of the joys of actually no longer being an academic is I basically don't have to be worrying about coming up with solutions that are publishable as part of this. But it's basically when you're looking at systemic risk and you're trying to measure some sort of a premium or identify some sort of a premium, it's going to be difficult, if not impossible, to try to separate that from other sources of premium. Certainly it's going to be difficult to extract anything from the historical data. Yet the potential problem of these rare, and if the event happens, there's going to be demand for it. Okay, so that's something you're going to have to deal with. To take it one step further and look at two-sided markets, which we're dealing with all the time, and look at something as simple as currency. Currency is a natural two-sided market. Now, if there is a currency which is basically the present equality currency, almost by definition, the other side has to have has got systemic risk premium associated with it. You know, again, other than the fact that you're doing one in the denominator, one in the numerator, the directionality has to be in opposite direction. So if there's a slight equality currency, and there's going to be an adjustment in the return on that currency to reflect that, there has to be a premium on the other side. And so that's something that we at least ought to be thinking about when we're trying to deal with some of these issues. Now, there are a number of components that I think either are cause or result in all of the systemic shocks, at least I'm aware of. First one is, and it ties into the title tonight, is liquidity events. I'm going to make the case that liquidity events can and have led to, or at least contributed in important ways to systemic shocks. They don't have to, though. Okay? And it's also going to be the case that I can't at least think of any systemic shock that wasn't then accompanied by some sort of a liquidity event. The other thing you're going to see in these kind of cases is you're going to see spikes in the volatility or the uncertainty around the markets. Best example, I gave you October 1987. October 19th, 1987. The average VIX, or the old VIX, over the last 20 years has been below 20 on a daily basis, looking at the closes. There have been 4 times when it's been above 40. It was in 1998, 2001, 2002. All of those got close to around 50. On October 19th, 1987, the old VIX closed at the end of the day at 150. Okay. Basically, that's off the charts compared to everything else we're looking at here. But again, that's an example of what I was talking about before. The other thing which is important to realize in these things is that a lot of the things we're dealing with, in a lot of these cases after the fact, there's going to be some faulty assumptions we dealt with. We talked about portfolio insurance. There were a lot of things that, we didn't understand about the marks. There are a lot of assumptions we made then that were not correct. These faulty assumptions, almost any of these kind of events, are going to be related, are going to be tied to and associated with, after the fact, use of models in ways that they, again, were stressed beyond the point of view. Models are tools. If you make assumptions, when the assumptions are wrong, you can get in, that's when you can get into problems. When the assumptions get real wrong and you don't realize it, that's when an October 1987 can happen. So those are the kind of issues that you're dealing with in this. On the other hand, liquidity, if you look at some of the liquidity, liquidity, it's one of these things where it's difficult to precisely define, and it's even more difficult to precisely measure. You look in Sharpe's textbook. His definition, I think is in that spirit. He defines it as, or describes it as the cost of selling or buying a security in a hurry. That makes sense, it's absolutely right. But it doesn't give you a lot of precision in terms of trying to measure it. Chacko and Stafford tried to put a little bit more structure on that. They defined it as the gap between fundamental value of a security and the price at which the security is actually transacted at. In other words, high liquidity means there's going to be a small gap. Lesser liquidity means the gap will be wider. The problem with that is, again, it makes sense, but we really never know exactly what the fundamental value is. That's an important component in all of this, both in terms of liquidity and then its potential impact on systemic shocks. And think about what happens with liquidity events. I would argue that there are 2 major factors that go on in some sense. One is there's increased uncertainty about that fundamental value. But think about it in terms of the markets today. With all of the potential capital in the hedge funds or in the proprietary desks or in other forms of active management, where you've got all these smart investors with the state-of-the-art systems and models basically waiting to swoop in and take advantage of any price discrepancy. You know, the thing's traded down a half a point in some of these markets. That's more than enough in many cases to go in and try to take advantage of that relative mispricing. What happens in a liquidity event is those buyers wait. Why? Well, I would argue that in many cases it's because there are a number of things going on, but it's all going to be related to uncertainty about fundamental valuation. I mean, at the most basic point, the reason they wait is they think they can buy it cheaper the day after or the day after that. Okay. More specifically, they probably also are less confident that this is actually going to bounce back in any kind of short-term nature, that they're going to be able to take advantage of this, that it actually could get worse before it got better. And that's tied to how confident they are in their fundamental valuation. Flip that, go to the other side. Why don't sellers wait? They don't. They wait. I mean, it's very obvious. They wait because they don't wait because they need cash. They've had margin calls. They've had redemptions. Whatever it is, there are needs. There are times when the seller can't wait, and that combination is what leads to these liquidity events. Go back to 2005. Just think about the convertible arbitrage market or the credit market in April. In the convertible market, in particular, you had redemptions going on. You had basically there was a lot of money on the sidelines that could have invested. There were a lot of multi-strategy funds. There were a lot of the prop desks that still had good money around. They didn't go in. One is they didn't know where the bottom was. Second, they thought these things could go to lower levels. Third, the theoretical values had gotten tighter and tighter and tighter to the point where when they started unwinding, people weren't quite sure where they were going to unwind to. So there was increased uncertainty about that fundamental valuation. Okay. That's going to be an important component of any of these liquidity events. Okay. Uncertainty about fundamental value and forced transactions. Now, from the point of view of liquidity premium, trying to measure that is at least potentially going to be easier than trying to come up with a measure of the systemic risk premium. In some ways, it has to be tied or related to, or at least partially related to the bid-ask spread. Okay? It's going to depend on what the cost is of getting in and out. And that's something that, at least in some ways, is observable. Although one of the things you're going to be dealing with is that's a number that will and should change over time and will differ depending on the size of the positions. The other thing that you have to be going for you is when you're looking at the liquidity risk, it ought to be negatively correlated with the accuracy of measuring the fundamental value. The easier it is to understand it, first off, it's going to be easier to hedge. There's going to be, in fact, if you can really measure it, there's going to be something that's a cleaner, more liquid alternative to that you can tie it to. You can hedge easier. And it's just going to be, you're going to have more comfort being that buyer swooping in to take advantage of the mispricings. Now, when you try to look at these together, and I would argue that in some ways it's going to be always very difficult to separate systemic risk and liquidity risk, at least in terms of measurement. Changes in the risk premiums are certainly going to be highly correlated. Just think of the two cases that I described. If the perception of the increased likelihood of a systemic shock, in other words, there's at least more and more concern that something is going to happen to the system, that should result in an increase not only in the risk premium from a systemic point of view, but it's going to also increase the risk premium required for investing in illiquid assets. On the other side, if you think that liquidity events can lead to a systemic event, you could say, for example, October 19th, there were events that led up to that created basically there were liquidity event type events that snowball into a systemic event. Okay? If you view that sequence is possible, then they also have to be highly correlated, interrelated. In some ways, with both of them, if you're going to try to price this ex ante. You're almost trying to anticipate the unanticipated. They're both going to be subject to the same kind of events, the same unanticipated sources of risk that can basically result in, again, the risk premiums ought to be going in the same direction. Now, one thing I am going to propose here is that a lot of the things I think we'll find that it's going to be easier. Just as, I'm an old MIT options person. Okay, and I basically, I'm old enough to, when I learned this, they didn't call it derivatives yet. So, but replication is important, and these relative pricing issues are important, and I think there's a lot that can be gained in this space. I think trying to measure some of these things on a relative basis, or at least looking at relative pricing across, in some sense, different forms of replication, is going to be interesting and provide some great insights into this. The implications of looking at this from a replication point of view. Is it going to be more expensive, or is there going to be more exposure to liquidity risk in the underlying securities? And this kind of follows up on some of the questions we had at the end of the previous session, or in the replicating derivative. Is there more exposure to systemic risk in the underlying securities or the replicating derivative? Now I'm going to offer a little, and I'm going to take it back, because I'm going to say it depends. And I'm going to give you an example where I think that I can make that point. Last year, we actually did trade in this. Total return swap on the Morgan Stanley Emerging Markets Index. Okay. Now, I think the way the swap works is you're going to receive, if you're receiving, on one side you're going to receive the total return on the index. In other words, you're going to get the total return as if you had invested in all of the stocks in the weights of the Morgan Stanley Index, as reported. On the swap, you're going to pay LIBOR plus or minus a spread. Now that market typically trades, if you're going to be long that swap, but you're going to basically be receiving the total return index. You're going to typically pay LIBOR minus 25 or 50. Now if you put your cash in LIBOR, you're going to earn, everything else equal, the index plus 25 to 50 basis points. There's a premium for doing this. Now you could argue that's a liquidity premium or a systemic risk premium in this particular case. It certainly is related to the costs and the difficulty of going short in those markets. You're providing somebody a security that they can use for hedging, and that they can lock in the hedging, lock in the short, in a way that they don't have to worry about all the intricacies of the market and all the different challenges of going short in individual securities. Okay? In May of 2006, that security, now in that month, yes, everybody knows the emerging markets index, the stocks have basically had a great run over the last several years. But it happens in that month. That was the one where the headlines of that month on CNBC were whether or not there was going to be a meltdown in the emerging markets. Okay. For the month of May, the index was down over 10%. Now, at that point in time, you could basically put on the same swap, where you were, instead of paying LIBOR minus 25 to 50, you were paying LIBOR minus 125 to 150. Why? Because there was greater demand for the hedge. There was greater demand for the ability to lock in that short. Okay? It was related, obviously, to the increased cost and difficulty of going short. It was related to worsening liquidity in the market. It was also potentially related to increased systemic risk. Okay. Now, the reason I said it depends, because everything I just talked about there is relatively short term. It's clear that this is going to be less liquid. It's easier to buy and sell the individual securities than trying to buy and sell the swap typically, the reason why it's paid this way. There's no exchange traded at any of the swap, whereas a lot of the securities are traded, for better or worse. Okay? However, there's one element that I left out of this, why I say this, it depends. For this contract, yes, it is more illiquid, okay, in the very short term. But with 30 days notice, first off, it's got a term. It ends in 1 year. So in 1 year, I'm out of it. I don't have to worry about selling if the contract ends. There's no executing and trading at the end to close it out. The contract ends, the cash flows are done, and we're through. The other thing is the same contract that did this offers basically the ability to redeem earlier or basically cancel the contract early in the first year, for a 1% penalty. So for 1%, I could get out of this contract with 30 days notice. Okay, so when you look at the, how that works, in some cases this contract will probably have better liquidity, in some cases it'll have worse liquidity than the underlying. Now I had a lot more slides, but basically because of the time, and because I don't want to keep us away from the reception, and Tobias actually has some answers as opposed to my questions, I'm going to basically cut through this, but I'm just going to stop with a few closing comments. One of the things I talked about 1987. One other event that I think is important to realize, that in a situation of systemic risk, which was certainly one, but after the fact we didn't have the shock, was Y2K. Y2K is a great example of a liquidity event. There were certainly issues associated with that. And it was certainly a systemic risk. And this is the important difference between a systemic risk and the actual shock. Companies spent billions of dollars trying to deal with this, the uncertainty that was associated with this. A lot of people, maybe some people in this room, they spent their New Year's Eve and New Year's Day weekend in the office because they didn't know what was going to happen. Okay? It was a real event, and there was talk about meltdowns in the systems. And the thing which, to cut this short, one of the things which came out of that, there's some good work on this, but the Federal Reserve basically stepped in there. One of the things we knew about this, we knew, unlike most of these kinds of events, we knew if it was going to happen, when it was going to happen, and what was going to cause it. And the Federal Reserve basically did a lot to increase the confidence of investors that they were going to basically deal with this. They were going to provide liquidity, and because of that, the markets effectively, although you could see in some of the fixed income markets there was a liquidity premium, it was small. And by the end of the year, there was enough confidence that November of 1999, a month before Y2K, was the biggest IPO month ever, by more than 50% higher than the previous and the since high month. Okay? And the stock market was up over 10, the S&P was up over 10% in December. The Russell 2000, the small cap stocks, which are the ones who presumably the most sensitive liquidity, they were up over 20% for the year, and they were up 10% in the last month. There was no flight to quality. Treasury rates rose over the time period. So again, there was an event, but it was one that we managed. So within that respect, liquidity events can cause systemic shocks. I think October 1987 is a good example of at least contributing to that. In most cases, and especially in today's environment, I think one of the things we've seen since 1998 is less and not more contagion. I think we're seeing more and more liquidity events happen that the system has handled, and it may be painful to some, but basically they're less likely to have led to systemic shocks. Systemic shocks are usually caused by something that we didn't anticipate. We've done a great job of fixing the previous problems. We never had problems with the volume and the trading after 1987. We've done a great job of dealing with those. It's the unanticipated is the thing we have to worry about. The central banks have and can continue to play an important role in moderating the impact of these shocks. Again, Y2K is a good example of that. 2001 is a great example of that. Couple of things to think about. To date, at least most of these recent events, the systemic shock and the impact of it has been relatively temporary. It's been relatively short term. Doesn't mean it always has to be. If you go back to 1929 and the events of that, it's hard, maybe they weren't permanent. The market continued to, it has grown and grown, but they certainly were long lasting. Okay? With that, I'm going to turn it over to my colleague, Togus.
No introduction.
But you need your slides.
Thanks for asking me to be the discussant. So what I will do is to sort of pick up some of the themes that you were talking about and give some complementary points. Oh, here we are. Okay. So I will give some complementary points to your discussion and sort of add some particular thoughts on the things that you were saying. Things stated for organizing this. I will also sort of get back to some of the points that Steve was touching on earlier. I am from the Federal Reserve, so nothing of what I'm saying here is reflecting the views of the Federal Reserve System. These are my own views, and this is my own, it's coming out of my own research. So what's happening in financial crisis? Well, typically sort of the stylus effects of financial crisis are that, you know, prices of risky assets drop sharply, prices of safe assets increase, and there's a flight to quality. As the price volatility increases and liquidity typically dries up. So I think, you know, a lot of people said today that liquidity is something somewhat hard to measure, and I think in the literature there's sort of different measures of liquidity that people are using, and they're sort of all getting at liquidity, but you know, they're all imperfect measures. The bid-ask spread is definitely a measure of liquidity. Price impact is a measure of liquidity, i.e. if you want to sell a large position in an asset, how much are you going to move prices against you? And actually, what put that resiliency, how long it takes for prices to come back after decline and due to sell. So in financial crisis, volatility increases, liquidity dries up, and I think the key feature, which is sort of distinguishing a financial crisis or instances of illiquidity from systemic risk, is that, you know, some institutions might become financially distressed, i.e. They might run out of capital. Now, in a systemic risk event, or what I understand, a systemic risk event is really an event when there are many institutions that become financially distressed. And I think, you know, people, particularly policymakers, are worrying about systemic risk because in a situation when many financial institutions can become financially distressed, this might have an impact on real economic activity, i.e. financial markets are there to allocate capital across different real economic actors. And when many institutions become financially distressed, this might have a real impact, and this is why a lot of people are worrying about financial distress. Now, financial distress sort of does not mean systemic risk per se, so I think you can think about instances, you can sort of contrast instances of financial distress, some of which did have a larger impact and others didn't. So Amaranth went bankrupt last fall and really was a non-event in terms of, from a systemic point of view, right? Versus LTCM, which actually had smaller capitalization than Amaranth, you know, created sort of some sense of a systemic risk, and we'll sort of come back to LTCM a little bit more. Similarly, if you compare REFCO versus Drexel, when REFCO went down, I think it was something like 18 months ago, REFCO was, you know, one of the biggest commodity brokers. It was a complete non-event. There was a little bit of volatility that went up around the default of REFCO, but it was essentially, there was no systemic impact due to REFCO's default. On the other hand, when Drexel went down, essentially the high yield market totally dried up. Drexel was so important for the high yield market and the LBO business that it had sort of a lasting impact on the functioning of that market. So sort of like, you know, this is like motivation, and then we'll try to sort of give some answers to why there are these different, you know, different events of financial distress and financial institutions have different impacts on financial markets. And I think what really matters when thinking about systemic risk is who is holding what, i.e., where are risks concentrated across financial institutions, i.e., to what extent are risk exposures correlated across institutions? Are all institutions sort of exposed to the same risk factors, exposed in the same direction? Are risks concentrated in weak balance sheets, or are they in strong balance sheets? Are there institutions that have a lot of capital behind them, or are sort of players that have weak balance sheets that take on a lot of risk? And in turn, when there's a crisis, when there's a financial distress, are there institutions or are there players in financial markets out there that still have capital and that can take over the positions of the institutions that are in financial distress? In particular, what we sort of see in different financial crises, for example, the 87 crash that Roy was talking about quite a bit, is that sort of the normal liquidity providers can become liquidity drainers in certain instances. So, for example, in the 87 crisis, sort of, the buy side, but even investment banks, certain investment banks started to be financially constrained. Similarly, in the LTCM crisis, sort of LTCM was really a liquidity provider in normal times. They were putting on liquidity trades, but during the crisis, there was sort of draining liquidity from the system. On the other hand, once again, things were different with Amaranth and Repco. So the major institutions are. So here, I just want to sort of give an outline of what are the major trends of the past couple of years. So I'm plotting here total financial assets of security brokers and dealers and of hedge funds as a fraction of commercial bank total assets. So this is sort of what everybody is talking about, is that assets are becoming more and more tradable. Sort of assets are moved off the balance sheets of commercial banks into institutions that are trading a lot. And so at the moment it's something like nearly, well, it's 26% or so of the total financial assets of commercial banks. Security brokers and dealers have roughly 26% of the size of total financial assets of commercial banks. So, thinking about systemic risk, I think it's really important to think about the roles of these different financial institutions. Commercial banks sort of have the easiest play because commercial banks have access to the discount window, so they have sort of always a way to borrow from the Federal Reserve if they become financially constrained. And commercial banks, furthermore, have very large balance sheets due to their loan portfolio. However, I will show in a moment, you do have risk management within the commercial bank, which can interact with market liquidity in financial crisis. Investment banks don't have the access to the discount window. They are perhaps more highly leveraged than commercial banks, and they manage their leverage and manage their risks. And this risk management in turn is interacting with market liquidity. And finally, you have hedge funds that are some hedge funds. I mean, most hedge funds, most capital under management in hedge funds is not very highly leveraged. Most capital in hedge funds is in long-short equity, where leverage is not very high, but some strategies do have high leverage, and this high leverage might lead to financial distress when sort of tail events are hitting. So I just want to show you 3 plots that are sort of linking market liquidity or financial crisis to these different types of institutions. So what you're seeing here is the blue line. So on the x-axis here is 98 to 2000, this is weekly data. The blue line you can think of as an indicator of the tightness of the value at risk constraint of commercial banks. So what I'm doing is to essentially construct an indicator of aggregate tightness of the value of how binding the value at risk constraint of commercial bank, of the trading floor of commercial banks is. And what you're seeing here is that sort of during 98, this value at risk constraint was sort of getting tighter and tighter. And in September 98, so first in August 98 was sort of the first spike, and then September 98 is the second spike, when LTCM started to be distressed. The bid-ask spread, which is in red, this is like my liquidity indicator here, the treasury bid-ask spread exploded. So the point that I would like to make here is that yes, commercial banks have very large balance sheets, but you have risk management on the trading floor. And during 98, sort of this VAR constraint was tightening up, so that once you had the Russian crisis, you know, the trading floors that the typical liquidity providers stopped sort of providing liquidity. So in particular, you can sort of formally show that by running forecasting regressions, and what we sort of find is that these changes in the value of risk constraint of the banks are forecasting market liquidity indicators, and controlling for everything you can think of. So there's sort of a direct link between the risk management and the management within the financial institution and market liquidity. Now, you find a similar thing in investment banks. So here, what I'm plotting here is the equity cushion, which is equity divided by, in particular, it's the growth rate of equity cushion. So it's the equity divided by total liabilities of investment banks against collateralized borrowing here on the y-axis. And what you can see is that sort of for every single bank, you have a negative slope. So when in order to increase the equity cushion, i.e. in order to unwind leverage on the balance sheet, what investment banks are doing is to adjust collateralized borrowing. So essentially what is sort of, when you take this argument a little bit further, what's happening in equilibrium is that if you have a negative shock to the asset values, realized leverage of banks is going to increase. In order to bring leverage back down, to bring up the equity cushion, these collateralized borrowing transactions, i.e. repo, in particular repo transactions, are going to be unwound in order to bring down the total size of the balance sheet. Now, in equilibrium, this can sort of have an amplifying effect on asset prices. And I think sort of after the LTCM crisis, what people were saying, or after the 87 crash in particular, what people were saying is really that it's this equilibrium effect of the risk management of financial institutions is interacting with market prices because in order to manage risk, institutions are starting to unwind. The last plot that I want to put up here is sort of going to hedge funds, which I think nowadays are the third important player. And there's sort of a large literature that is showing that hedge funds are taking on tail risk. So in particular here, what I'm plotting is sort of the exposure of hedge fund returns to the volatility index. And what you can see is sort of like this is the middle of the distribution. In the tail of the distribution, in both the positive and the negative tail of the distribution, exposures of hedge fund returns to volatility are very different. So in financial crisis, this exposure to volatility is extremely strong, which is sort of consistent with the notion that hedge funds, or at least some hedge funds, are generating returns by taking on tail risk. So what I'm doing here is to sort of propose a trading strategy that is offloading some of this tail risk. Now obviously by offloading the tail risk, you shift the whole distribution and you reduce average returns. So the fact of what's happening is that, what the data is telling you is that hedge funds are taking on tail risk, but I guess the point, or the question that I would like to raise is sort of, who are the natural holders of tail risk? I think, and so the financial innovation that Roy was talking about is really, there are a lot of products out there, such as various swaps, credit default swaps, or the emerging markets total return swap, that are sort of instruments that allow you to trade tail risk and to make tail risk sharing more efficient. So in turn, who is holding this kind of tail risk is going to determine what's happening in the financial crisis, i.e. is the tail risk in the hands of large balance sheets or in the hands of small balance sheets. And I think sort of a question that I don't have a good answer to is really, what are the institutions that should hold tail risk, and are the institutions that are holding tail risk sort of managing that risk adequately? So to end off this discussion, these are the returns to the fixed income arbitrage funds, and here you sort of see the tail risk that occurred in the fall of '98, where you have sort of normally fixed arbitrage funds are not very volatile, but suddenly you have this huge negative realization. And, I think this is what systemic risk is really about, and it's really about asking who's holding the tail risk.
Do we have one or two questions? One question.
Hi, I need to sort of build a capital. The question is, would you have a guesstimate on what sort of mortgage default rate it would take to create the balance sheet compression you're talking about?
Sorry, can you?
What sort of residential mortgage default rate do you think it would take for banks to be forced to compress their balance sheet so they realize VAR hits their limits?
That's a very good question.
Do you have a guesstimate? 2, 8, 6, anything?
I'm going to just throw in one thing which isn't going to answer the question, but it's basically one of the things which you're seeing right now in this market is an example of, the different institutions dealing with this. If you look at, there was a story not too long ago, and I'm Farallon, which I'm just using because I haven't seen this story, but all the large hedge funds and all the large investment banks actually are looking at potentially being buyers of these things. Farallon, in the same day I saw stories talking about them lending to mortgage providers, proposing to buy mortgage providers, and buying pools of mortgages from those places. So basically, these guys also are setting up their own servicing companies. So this evolution of this, basically, that question is probably a much more complicated one to answer these days, because a lot of that capital is, it's taking some time. Obviously, there's no liquidity event in that space, but the money moving around right now there is unbelievable.
If you can control the inventory and supply or pipeline of platform shoes and leisure suits, it affects the outcome.
I'm trying to go from the liquidity event to the financing. I don't know that, as both of you alluded, we reach the point where we can solve liquidity events without even blinking. Amaranth is who cares? But I'm not sure we can solve financing events. And if you reach a point where banks won't lend, the haircut goes from 20 to 40% on your bonds. That's where you have a systemic crisis. And it has to be driven by their VAR hitting their cap. And trillion-dollar question is at what default rate do you reach it? Because
Well, actually-
every chart you read is heading this way right now on mortgage defaults.
Roy, to broaden the question, one of the things that occurred to me as I was looking at your slides, and I think it came up in the buyback slides as well, is there a difference of quality or a difference of kind between a contraction and credit extension and a systemic problem or liquidity, and how does that relate to liquidity risk, asset liquidity risk, or an aging problem? I think to sort of take the question away from just a specific asset class, that broader question is kind of there, I think, hidden in the background.
Yeah, and I guess one of the things I think, the answer is I don't know. And the reason I don't know is because I think, if you kind of go back to when I was in graduate school, and they were talking about these liquidity events, and basically the banks didn't lend, and there weren't the alternatives now. So the dynamics out there are such that the question is one of kind of what is the time dimension you're looking at, and I think to really have any kind of a long-term credit crunch, there has to be some sort of systemic event that's creating the uncertainty that has kept the capital from moving around like it's at least starting to try to do in the mortgage market. That doesn't mean some of these people aren't going to get burned in this, but the ability and the speed that the markets are moving around some of these things, some people will get certainly hurt, but the liquidity events and the ability, for example, I was just on a phone call with one of our managers, basically, who was talking about there's a new CDO coming out this week where the AAA tranche is pricing at LIBOR plus 65. The AA's, I believe, is pricing at LIBOR plus 100. Those are about 10 basis points wider than they were back in December. So the market's not dead. It's not dried up. Now, does it mean that there is situations that it could if this got a lot worse? I don't know what the level is of this, but basically, at least in the short term, the market, the dynamics of this are such that it's throwing out a lot of the empirical data in terms of how you evaluate its impact.
Fred, remember about 18 months ago, we could find AAAs, shorter dated AAAs trading at LIBOR minus 5 or LIBOR plus 2. So that's a pretty wide move for AAAs. Is there one last question? You had a shot. We'll give it. Okay.
I'm giving this whole night presentation. Looks like the liquidity risk is what I'm getting more and more attention from the whole industry because I think the balance sheet is moving from the banking book to the reading book. Now you start wondering if VAR good enough and the stress test good enough. Is there a kind of trend or some new risk variant evolving from the industry? Or do you see that as a theme?
And as far as I know, I think stress tests are really the state of the art. But there are many ways of doing stress tests. So, the way you are modeling liquidity in a particular stress test, I think is important. But I haven't heard of new methods.
Yeah, I mean, I think the question really is you need to be asking yourself is what haven't I thought of? A year ago, the risk that people that was the potential source of uncertainty was the documentation process, the settlement process. There's still, I think, there are a lot of problems with that, but I think I think there's a lot of progress that's been made there. So it's those issues. I mean, it's at the end of the day, what really is going to cause a problem is cases where people don't honor contracts, where basically there are very large players or very large players in the aggregate that are defaulting on the same contracts. Amaranth was a blip because there was a lot of money made on the other side, and there wasn't this aggregation of default. It's a sense that's the issue you've got to deal with, and I think that's the concern that at least if you're going to look for some things to be concerned about, it's going to be those aggregations and how those work. One of the things which is even with all the better transparency that we're having and the better relationships between the prime brokers and the hedge funds, a lot of the prime brokers don't necessarily know who the other prime brokers are for the same hedge fund. They see their book and they know what's going on there, but they don't necessarily know that at least we've come across plenty of examples where prime brokers don't know. We know more about the prime brokers of a particular manager than the prime brokers do.
And so it comes down to an agent-based modeling exercise as opposed to a asset-based modeling exercise. With that, I'm going to actually try to wrap this up. I'm going to first of all encourage everybody here who's interested, contact the IFB to see how maybe you might be able to get involved in our Liquidity Risk Committee practitioner working group. If you're looking to speak to people about that this evening, there's myself as one of the co-chairs, there's Roy Henriksen, and then one of the co-chairs of the actual practitioner working group is Steve Allen. So feel free to chat with any of us a little bit about that, and then contact David Jaffe, the IFB, as to how we can organize that. The last thing that I probably want to say as a closing comment, and I'm going to leave this as a bit of a puzzle. Tobias, you had a very interesting slide about that equity cushion around investment banks, and then needing to reduce exposure by basically delevering and selling balance sheet. Okay, and this is an agent type concept here. Roy, we talked a little bit about the concept of flight to quality and a negative systemic risk premium. The interesting thing, though, is, of course, Myers and Rohit Rajan wrote a very nice paper on the liquidity paradox. And the liquidity paradox is if you're a leveraged investor, okay, you have an incentive in financial distress to sell your more liquid, high-quality stuff first and hold on to your more illiquid stuff. Now, that's an interesting thing because the thing that, depending on how many leveraged investors out there are in financial distress, the thing that's expected to move to gain in price, because it's a flight to quality, could actually, in the short run, fall in price. And then on the other hand, you've also got another set of leveraged investors who have more access to liquidity than the hedge fund might, but they're deleveraged. It's an interesting way to think about how do those dynamics result in an absolute movement one way or the other. And the cross correlations, which sort of have helped us keep volatility dampened in one scenario, might actually be the thing that results in a buildup or concentration in one place or another in another scenario where people didn't expect cross correlations to bind or have an effect. So I leave you to sort of think about that and think about, what other questions we might be asking in the future. Thank you very much, David.